Whether in traditional banking or in cryptocurrency investments, understanding APY and compound interest is crucial for making informed financial decisions. Hey, it's Grandpa here, who loves to talk about crypto. So, you've probably seen the abbreviations APY and APR, especially if you have a bank savings account or a loan of some type, like a car loan. Now, if you're not clear about the meaning of APY or APR, let's take a few minutes to explain them and see how they apply to both traditional banking and cryptocurrency investments. So, APY stands for Annual Percentage Yield. In traditional finance, APY represents the total amount of interest you earn on an investment or a savings account over 1 year, taking into account compound interest. The higher the APY, the more money you will earn. Let's look at an example. Okay, so let's say you deposit $1,000 in a bank savings account with a 5% APY compounded monthly. After 1 year, you'll have $1,051.16 as the interest you earned. But what does compounded monthly mean? Well, it's really important to understand. Compounded monthly means that each period, often monthly, but not always, you earn interest not just on your initial deposit, but also on the interest accumulated in the previous months. It's really important to understand this. So let's break down that 5% APY example. So to calculate the monthly rate that you're earning, take the 5%, divide it by 12, and you'll get a monthly rate of 0.004167, or about 0.4167%. So in the first month, that $1,000 is multiplied times 0.004167, which means you earned about $4.17 interest. But in the second month, that extra interest is now calculated at the higher rate. And this process continues each month with the interest amount slightly increasing. So if the interest wasn't compounded, you'd earn exactly $50, which is 5% of $1,000. But with the monthly compounding, you earn an extra $1.16. I know, big whoop. And while this difference might seem small, it becomes more significant with larger amounts and higher rates, or more frequent compounding. What do we mean by more frequent compounding? Well, it's really important to understand more frequent compounding when it comes to cryptocurrency. You see, in the crypto world, APY is often used in the context of staking and yield farming. Staking is similar to a savings account in a traditional bank. When you stake cryptocurrency, you're essentially locking up your assets to support the operations of a blockchain network. And in return, you earn rewards, often expressed as an APY, an annual percentage yield. So, another example. Let's say you stake $1,000 worth of Ethereum at a 9% APY. Your potential earnings would be about $90 over a year if the Ethereum price remained constant. However, as you know, crypto prices can be volatile. So if your Ethereum value increases to 1,500, your staking rewards would be based on the higher amount, potentially earning you more. But, of course, if the value drops, your rewards would be based on the lower amount. So now let's look at compounding in crypto. Many staking platforms automatically reinvest your rewards, creating a compound effect similar to what we discussed in traditional savings accounts. This can lead to earning interest on your interest. potentially increasing your overall returns. Now, it's important to point out that while crypto staking can offer higher APYs than traditional savings account, it also comes with higher risks because of that price volatility we mentioned and other factors that are very specific to the cryptocurrency market. So, in conclusion, whether in traditional banking or in cryptocurrency investments, understanding APY and compound interest is crucial for making informed financial decisions. So always consider the risks and the potential rewards when choosing between different investment options. So now let's talk about APR. What is that? Well, imagine it's the yearly price tag for borrowing money. It's like the cost of renting cash, if you will. APR includes both the interest you pay and any fees involved, but here's a little secret. It doesn't account for compound interest. We'll get to why that matters in a bit. Now, where do you usually see APR? It's the star of the show when it comes to loans and credit card debt. And here's a golden rule to remember. The lower the APR, the less you'll pay in interest over time. That's simple. So let's break this down with another real-world example. Let's imagine you have a $1,000 balance on your credit card, and it comes with an 18% APR. If you decide to ghost your payments for a whole year, which we don't recommend, by the way, you'd owe about $180 in interest. But hold on. Remember the little secret about compound interest? Yeah, in reality, you might end up owing even more. Sneaky, right? So now let's take a crypto twist on this. In the wild world of digital currencies, some platforms are offering crypto-backed loans. And guess what? They're using APR too. Now you might come across something like borrow US dollars against your Ethereum at 8% APR. Not bad considering. But wait, there's more. We can't talk about APR without mentioning its cousin, APY, or annual percentage yield. These two often show up in investment decisions, and knowing the difference can be a bit of a game changer. In the traditional finance world, a higher APY on savings accounts is like a magnet for savers. More interest. On the flip side, if you're borrowing money, a lower APR makes borrowing look way more attractive. Now, what about in the crypto universe? Well, high APYs on things like crypto staking or yield farming can make investors' eyes light up like a Christmas tree. But remember, folks, if it looks too good to be true, it probably is. These high rates often come with their fair share of risks. And those low APRs on crypto-backed loans, they might tempt you to borrow more and dive deeper into the crypto pool. So let's just review and break down the key differences between APR and APY. Compounding. APY is the overachiever that includes compound interest, while APR is the laid-back cousin that doesn't. Think of APY as your earning buddy, savings, investments, and APR as your borrowing pal, loans and credit cards. In practice, a 5% APR will be kinder to your wallet than a 5% APY. And here's a pro tip. APY will always be higher than APR for the same rate. So, there you have it. Understanding APR and APY, well, it's like having a financial superpower. Whether you're dealing with your good old bank accounts or diving into stocks or getting involved in the crypto world, knowing these terms is crucial. So let's just say it again. For earnings, higher is better, go APY. And for borrowing, lower is the way to go, APR. Before we wrap up, here's a quick challenge for you. Next time you're looking at a financial product, spot the APR or APY. But remember, guys, no matter what you do, please remember the Dypto refrain. Learn before you leap.